The investment landscape is in constant flux, presenting both challenges and opportunities for sophisticated investors. Traditional asset classes, while foundational, often face headwinds from market volatility and compressed yields. This environment compels a deeper exploration of alternative strategies. For those seeking enhanced returns, diversification, and a degree of insulation from public market swings, alternative investments have become increasingly vital. Among these, private debt funds have emerged as a compelling and rapidly growing segment. They offer a unique proposition in today's complex financial world. This discussion will delve into the intricacies of private debt funds. We will define what they are, explore their various forms, and dissect the compelling benefits they offer. We will also critically examine the inherent risks and consider the current market trends shaping this dynamic asset class. Private debt funds represent a form of direct lending to companies, bypassing traditional banking channels. These funds pool capital from institutional and accredited investors to provide loans to businesses. This lending activity occurs outside of public markets. Unlike public bonds, which are traded on exchanges, private debt involves bespoke, negotiated loan agreements. These agreements are tailored to the specific needs of the borrower and the lender. This direct relationship is a defining characteristic. Private debt also differs significantly from private equity. While private equity involves taking ownership stakes in companies, private debt focuses on providing capital in the form of loans. The primary objective is interest income and principal repayment, not equity appreciation. Key characteristics of private debt include its illiquidity, meaning capital is locked up for extended periods. Terms are highly customized, reflecting direct negotiation between the fund and the borrower. This allows for greater control over loan structures and covenants. The role of private debt in the financial ecosystem has expanded significantly since the 2008 financial crisis. Stricter regulations on banks led to a reduction in their corporate lending activities. Private debt funds stepped in to fill this funding gap, particularly for middle-market companies. The private debt universe is diverse, encompassing several distinct strategies, each with its own risk-return profile. Understanding these variations is crucial for investors. Each strategy targets different types of borrowers and financial situations. Direct lending is perhaps the most common private debt strategy. Funds provide senior, unitranche, or junior debt directly to companies. These loans are typically used for growth capital, acquisitions, or recapitalizations. Senior debt holds the highest priority in a company's capital structure. It is often secured by the borrower's assets, offering a degree of capital preservation. Unitranche debt combines senior and junior debt into a single facility, simplifying the capital structure for borrowers. Junior debt, including second lien loans, ranks below senior debt in repayment priority. It carries higher risk but also offers higher potential returns. Direct lending funds primarily focus on established middle-market companies that may find traditional bank financing less accessible or flexible. Mezzanine debt is a hybrid form of financing, blending characteristics of both debt and equity. It typically ranks below senior debt, but above equity in the capital structure. Mezzanine loans often include an equity component, such as warrants or options. This equity kicker provides an additional upside potential for lenders. Mezzanine debt is often used to finance leveraged buyouts or significant growth initiatives. It appeals to companies seeking capital without diluting existing equity ownership too heavily. Due to its subordinated nature and equity features, mezzanine debt carries higher risk than senior debt. Consequently, it demands higher interest rates and expected returns. It is a more complex instrument requiring specialized expertise. Distressed debt strategies involve investing in the debt of financially troubled companies. The goal is to profit from the restructuring or turnaround of these businesses. This can involve purchasing debt at a discount in the secondary market. Investors in distressed debt aim to influence the restructuring process. They may convert debt into equity or participate in the company's reorganization. This strategy requires deep credit analysis and legal expertise. Distressed debt is inherently high risk, as the outcome depends on the successful rehabilitation of the borrower. However, it can offer substantial returns if the turnaround is successful. It is often countercyclical, performing well during economic downturns. Special situations debt encompasses a variety of niche lending strategies. These include venture debt, real estate debt, and infrastructure debt. Each targets specific sectors or asset types. Venture debt provides capital to early-stage, high-growth companies that may not yet be profitable. It bridges the gap between equity funding rounds. Real estate debt funds lend against commercial or residential properties. Infrastructure debt finances large-scale projects like roads, bridges, or utilities. These projects often have long-term, stable cash flows. Special situations debt requires specialized knowledge of the underlying industry or asset class. Asset-backed lending involves loans secured by specific assets, such as accounts receivable, inventory, or equipment. This strategy provides capital to businesses based on the value of their underlying assets. It is often used by companies with limited access to unsecured credit. The collateral provides a layer of protection for lenders. This reduces credit risk compared to unsecured loans. Asset-backed lending is common in sectors with tangible assets. Private debt offers a compelling array of benefits that attract a growing number of institutional and sophisticated investors. These advantages often address shortcomings found in traditional fixed-income portfolios. Understanding these benefits is key to appreciating its role as an alternative investment. One of the primary draws of private debt is its potential for attractive yields. These returns are typically higher than those offered by comparable public market fixed-income instruments. This yield premium compensates investors for the illiquidity and complexity involved. The illiquidity premium is a significant component of these higher returns. Investors are rewarded for locking up their capital for extended periods. This contrasts with the daily liquidity of public bonds. Private debt can provide valuable diversification to an investment portfolio. Its returns often exhibit a low correlation with public equity and fixed-income markets. This means private debt performance is less influenced by daily market fluctuations. Adding private debt can help reduce overall portfolio volatility. It offers a different return driver, enhancing portfolio resilience during market downturns. This diversification benefit is highly valued by long-term investors. Many private debt strategies, particularly senior direct lending, prioritize capital preservation. Loans are often secured by the borrower's assets. This collateral provides a cushion in the event of default. Lenders also benefit from strong covenants and direct oversight of the borrower. These protective measures are designed to safeguard the principal investment. Seniority in the capital structure further enhances this preservation aspect. A significant portion of private debt loans are structured with floating interest rates. This means the interest payments adjust periodically based on a benchmark rate, such as SOFR or Euribor. This feature can act as a natural hedge against inflation. As interest rates rise in an inflationary environment, the income generated by these loans also increases. This helps maintain the purchasing power of the investment. Fixed-rate bonds, by contrast, suffer during periods of rising rates. Private debt transactions are highly customized and directly negotiated. This allows lenders to tailor loan terms, covenants, and repayment schedules to specific situations. This level of control is absent in public debt markets. Lenders can impose strict covenants that protect their interests. They can also engage directly with borrowers, monitoring performance and intervening if necessary. This active management can mitigate risks and optimize outcomes. Unlike publicly traded securities, private debt investments are not subject to daily market pricing fluctuations. Their valuations are typically updated less frequently, often quarterly. This can lead to a perception of reduced volatility. While underlying credit risk remains, the absence of daily mark-to-market pricing can smooth reported returns. This stability can be appealing to investors seeking less volatile portfolio components. It provides a calmer investment experience. While private debt offers compelling advantages, it is not without its risks. A thorough understanding of these potential downsides is essential for any investor considering this asset class. Prudent risk assessment is paramount. The most significant risk associated with private debt is illiquidity. Capital committed to private debt funds is typically locked up for several years, often 5 to 10 years or more. There is no active secondary market for these loans. Investors cannot easily redeem their capital before the fund's maturity. This lack of access to funds requires a long-term investment horizon. It also necessitates careful planning regarding capital allocation. Credit risk is inherent in any lending activity. This is the risk that a borrower will default on its loan obligations. While due diligence aims to mitigate this, it cannot be entirely eliminated. Private debt funds lend to a range of companies, some of which may be smaller or less established. This can increase the potential for default. Thorough credit analysis and diversification across multiple loans are crucial. Valuing private assets, including private debt, can be challenging. Unlike public securities with readily available market prices, private loans require complex valuation methodologies. These often involve models and assumptions. The subjective nature of private asset valuation can lead to discrepancies. It also makes it harder for investors to independently assess the true value of their holdings. Transparency can be an issue. Investing in private debt funds heavily relies on the expertise and capabilities of the fund manager. Their ability to source attractive deals, conduct thorough due diligence, and manage loans effectively is critical. Poor management can significantly impact returns. Investors must carefully vet fund managers, examining their track record, team experience, and investment process. Manager selection is a key determinant of success in private debt. It is a highly specialized field. The regulatory environment for financial markets is constantly evolving. Changes in banking regulations, capital requirements, or investor protection laws can impact private debt strategies. These changes may affect deal flow or operational costs. Unforeseen regulatory shifts could alter the attractiveness or feasibility of certain lending activities. Staying abreast of these developments is important for fund managers and investors alike. Compliance is a continuous effort. While floating rate loans offer an inflation hedge, they also expose borrowers to interest rate risk. If benchmark rates rise significantly, the cost of borrowing for companies increases. This can strain their financial health. Higher interest payments can reduce a borrower's ability to service their debt. This, in turn, increases the credit risk for the private debt fund. While beneficial for lenders, extreme rate hikes can be detrimental to borrowers. The private debt market has experienced explosive growth over the past decade, transforming from a niche strategy into a mainstream alternative asset class. Understanding the forces driving this expansion and current trends is vital. This growth reflects fundamental shifts in financial markets. Several factors have fueled the rapid expansion of private debt. Post-2008 financial crisis, stricter regulations like Basel III prompted banks to reduce their exposure to corporate lending. This created a significant funding gap for businesses, particularly in the middle market. Private debt funds stepped in to fill this void, offering flexible and tailored financing solutions. Simultaneously, institutional investors, facing low yields in traditional fixed income, sought higher returning alternatives. Private debt provided an attractive solution. The robust activity in private equity also drives demand for private debt. Private equity firms often rely on debt financing for leveraged buyouts and growth investments. Private debt funds are key partners in these transactions. The global private debt market has grown exponentially, now exceeding $1 trillion in assets under management. This growth trajectory shows no signs of slowing down. It has become a significant component of the broader alternative investment universe. The market has also matured, with a wider array of strategies and specialized funds emerging. What was once a relatively homogeneous market is now highly diversified. This evolution offers investors more choices and greater granularity. The The private debt market is populated by a diverse group of players. Large, diversified asset managers have established significant private debt platforms. Alongside them are specialized private debt firms that focus exclusively on this asset class. These firms compete for deal flow, bringing expertise in credit analysis, structuring, and portfolio management. The competitive landscape ensures innovation and efficiency within the market. It also highlights the importance of manager selection. The current economic environment presents both opportunities and challenges for private debt. Rising interest rates while increasing income for floating-rate loans also raise borrowing costs for companies. This could lead to increased credit stress for some borrowers. A potential economic slowdown or recession could test the resilience of private debt portfolios. However, it could also create opportunities for distressed debt and special situation strategies. Market conditions require careful navigation. Accessing private debt funds typically requires a significant capital commitment and a long-term investment horizon. This asset class is primarily available to institutional investors and high-net-worth individuals. Retail investors generally have limited direct access. The most common way to invest in private debt is through direct investment in a private debt fund. These funds are typically structured as limited partnerships. Investors commit capital that is drawn down over time as investment opportunities arise. Minimum investment thresholds are often high, ranging from several $100,000 to millions of dollars. This reflects the illiquid nature and administrative complexity of these investments. Due diligence on the fund and its manager is critical. For investors seeking diversification across multiple private debt strategies and managers, a fund of funds can be an option. These funds invest in a portfolio of underlying private debt funds. They offer broader exposure with a single commitment. Fund of funds can lower the effective minimum investment for diversified exposure. However, they typically involve an additional layer of fees. This can impact overall net returns. Business development companies, or BDCs, offer a more liquid way to gain exposure to private debt. BDCs are publicly traded companies that invest in debt and equity of private companies. They are often structured to pass through most of their income to shareholders. BDCs provide daily liquidity unlike traditional private debt funds. However, their share prices can be subject to public market volatility. They also may trade at a premium or discount to their net asset value. For very large institutional investors, separately managed accounts, SMAs, offer a customized approach. An SMA allows an investor to have a private debt portfolio managed specifically for their objectives. This provides maximum control and transparency. SMAs require substantial capital and are typically reserved for the largest pension funds, endowments, or sovereign wealth funds. They offer tailored solutions but demand significant resources for oversight. Given the illiquid and complex nature of private debt, thorough due diligence is paramount. The selection of a skilled and reputable fund manager is arguably the most critical decision an investor will make. This process requires significant effort. Investors must meticulously examine a manager's historical performance across various market cycles. This includes analyzing gross and net returns, loss rates, and recovery rates. Consistency and resilience are key indicators. Understanding the sources of return is also important. Was performance driven by specific market conditions or consistent investment acumen? A long and stable track record is highly desirable. A clear and well-defined investment strategy is essential. Investors need to understand the fund's target market, lending criteria, and risk management framework. The process for sourcing, underwriting, and monitoring loans should be robust. How does the manager identify opportunities? What is their approach to credit analysis? How do they manage defaults and restructurings? These questions are vital for assessing their operational capabilities. The experience and stability of the investment team are crucial. Private debt is a relationship-driven business that requires deep industry knowledge. A cohesive and experienced team is better equipped to navigate complex transactions. High turnover within the investment team can be a red flag. Investors should assess the depth of talent and the succession planning in place. The expertise of key individuals is a significant asset. Alignment of interests between the fund manager and investors is critical. This often involves the manager investing a significant portion of their own capital alongside investors. This demonstrates conviction in their strategy. Fee structures should also be transparent and fair. Performance-based fees should incentivize strong returns while protecting against excessive risk-taking. Clear communication on fees and expenses is expected. The operational infrastructure supporting the private debt fund must be robust. This includes systems for loan administration, compliance, and reporting. A strong back office ensures smooth operations and accurate reporting. Independent third-party service providers, such as administrators and custodians, can enhance oversight and transparency. A well-run operation minimizes administrative risks. It supports the investment process effectively. Private debt funds have firmly established themselves as a vital component of the alternative investment landscape. They offer a compelling blend of attractive yields, diversification benefits, and capital preservation potential. This makes them an increasingly important consideration for sophisticated investors. However, these benefits come with inherent risks, most notably illiquidity and credit risk. Navigating this complex asset class requires a deep understanding of its nuances. It also demands rigorous due diligence in manager selection. As traditional financial markets continue to evolve, private debt funds provide a powerful tool for enhancing portfolio construction. For those with the appropriate risk appetite and investment horizon, private debt represents a significant opportunity. It offers a differentiated path to achieving long-term financial objectives.